Welcome back, Jeff Gerstner over at Superior Lending. Jeff, quickly remind our folks exactly what you guys do over at Superior.
Yep. What we do here, we run a private credit fund backed by a family office. Think more mezzanine, getting ready to trip a covenant in an ABL facility, more manufacturing, industrial, anywhere around the Chicagoland area. Think something we can drive to and from in the same day. Anything outside of that, it's generally 5 million and up. We haven't been exceptionally busy in that. As we know, a lot of banks aren't in heavy workout mode or worried about covenants. So we get a lot of, we haven't seen a lot in that space. Anything outside of that, we place or participate. A lot of our stuff recently has been more on the placement side, I would say, just based on what we have as the mandate within the family office. And just kind of run the gamut on what we do. So
since last time we spoke, it seems like things have just gotten precipitously worse. We're talking about interest rates and the state of lending. We're talking about the idea that maybe we are in a recession. There are certainly individuals that are out there. Stanley Druckenmiller, who is a billionaire investor, he's making news this week because he sees a hard landing in 2023 with a possible deeper recession than many expect. What are you seeing on the ground?
It's hard for us to say, we're thinking it's going to be a recession. I think it's more, I don't know. I think we're in just such uncharted waters with what the Fed has done that I think people are in such a state of shell shock. And that I think we just have to kind of wait and see what happens here and how the economy reacts to, I would say, this almost cataclysmic shift in rates, and that just being everything from mortgages down to everything. You look at all the business, that the revolving, not the term debt per se, but the revolvers and all these, say, ABL, these asset-backed loans. I mean, they've all set 200-300 points higher, and it's crazy to think, and that is an enormous shock to where, say, somebody was at 1, now they're at 4. That's a big difference. I think it's hard to say. You still go outside, and it seems like there's just tons of business activity, especially here in Chicago, where you have still, it's also probably a factor of COVID, where we were, pretty shut down here, where now we're not shut down, and you're seeing businesses are still somewhat crowded. Restaurants are getting crowded. Some are packed. So it's hard to say it's going to be this. I think we just need to kind of wait and see what happens. And if the Fed continues down this path, it's very interesting. I don't know, I'm sure we'll get into it, but I'm sure you probably saw what the Bank of England did today, where they stepped into their bond market and they're raising rates, but they stepped in to buy the long end. It's kind of like, well, they're tightening, but now they're easing again. So it's, I don't know.
That was almost bipolar.
It's completely bipolar. But I've said that through all of this. I don't get. I just don't. You have mortgages in the 7s now. You have, the Fannie and Freddie multifamily rate sheets for the small balance in the 7s, and these are on ARMs. These are 5, 7, and 10-year ARMs at 7, where it was what?
So
2.5, 3.
The concern was in 2008 was the adjustable rate mortgages, the ARMs that you're talking about in the residential. We're starting to see a lot more of those now in commercial, aren't we?
Yeah. I think, people now, banks don't want to put out 30-year paper. They'd rather wait and see, just to kind of see, especially when you have rates so low. Before, people are, will do a 5-year term, with a 25-year AM or a 30-year AM. Now you're looking at, it's just crazy how big of a move we've had. And it doesn't happen immediately where what the effect's going to be. It just seems like the effect is going to take time to play out. So I think it's hard to say we're heading down towards a recession. I think a lot of parts of the economy are going to slow down. But if we're in a full blown, you could say we were already in a recession, right, for the first two quarters, depending on how you want to define a true recession.
Yeah, the Atlanta Fed right now is expecting that the third quarter might be just above zero, but then they review it over the next 30 days. We're not going to know what the third quarter is. So as you just correctly stated, quarter one, quarter two was negative GDP. That's technically a recession. There's political arguments against that now. Of course, politics intervenes in every discussion. But to that side, classic economist definition is we are technically in a recession. Now, it may be a mild recession. The third quarter is really going to dictate what we're looking at right now. And getting back to what you were just talking about, Jeff, you're talking about real estate lending, you're talking about adjustable rate mortgages. Patrick Carroll reported on CNBC this week. He's the founder and CEO of Carroll. It's a real estate investment firm. They're dealing with a lot of commercial real estate. He says lending has all but dried up. Are you seeing the same thing?
Yes. So I would say we don't see a ton on the CRE side, just strictly CRE. But you know what we're seeing a lot of all of a sudden? CRE. Just because you look at it's no different than I'd say SBA lending. We'd see a ton of SBA type loans that had to go SBA, I would say 2 years ago, but then you had COVID. So PPP, EIDL, ERTC take care of all that, right? And then people that, a business got a loan, a PPP loan at this bank through their SBA, they're going to do an SBA through that bank, obviously. So you don't need, they can kind of figure it out on their own. It's very interesting what has happened quickly, I think, in CRE. I think they're spot on. And I think I would say deals that are a little more complicated, people will call us on. And that's what we're seeing a lot more of. And because, the deals aren't simple now where you can just pencil out something. It's very hard to say and to pencil out and say those projections and this pro forma is going to make sense or come to fruition. And that's why we're seeing a ton. CRE lending, I think, has completely frozen. And it's going to continue to stay like that. And I think that's why, we see deals, we'll see more and more CRE deals just from from where we sit internally. Just because of that, just because it's not going to be easy and you can't just go slap it into a Fannie or Freddie loan and say, here we go. Or, it's just not there. So
if companies aren't able to refinance their existing loans, and let's say some of them bought in the last few years as the appreciations have just gone to unthinkable levels in many parts of the country. Now maybe they're underwater. What options do they have? Do the banks want to take back these properties? What do you do if you've got a client that basically needs to save their property from the bank coming in and taking it back, foreclosure or whatnot?
So what you're going to see, and the bridge lenders, the private bridge lenders, I would say, have been very busy. They will continue to be busy, if not get more busy, just from that simple standpoint. We're now, like I always tell people, your competition on a deal isn't necessarily, say we have like numerous gas station deals right now.
Yeah.
Say a gas station, your competition isn't that gas station next door that's refinancing. Your competition now is the whole market in general. Because everybody always says there's this plethora of dollars. Well, there's a plethora of dollars for exceptionally clean, squeaky clean deals. Any deal that has a little hair, a gas station is not easy to get done.
You got the environmental problems with gas stations all the time. They come up.
There you go.
Yeah.
And so you look at, so to me, it's you have to go to a private lender after that. And then people are, then they get mad because their rate's higher. They're paying fees to get out or to get pushed out. The hope is that if the bank is truly pushing them out, they get pushed out when there's still a chance for something to be done. Right now, there is not. The deals you'll see in workout, David, or deals that are getting somewhat gently pushed out of the bank, and no one's forcefully pushing anyone out right now. The ones that do come out, they're so far gone, you can't do anything for them. So it's very interesting what's going on. If the banks will be a little more proactive, their write-downs may not be as extreme. But the bank always has this in the back of their mind. If I kick out this $30 million credit, how do I price that $30 million credit on my balance sheet? Because they got to go back in the market and there's competition for deals, right? There's competition for clean deals, especially bank type deals. Banks are going to have to, but the number of bank type deals you're going to see now coming way, way down, right? Because if there is a slowdown, banks are going to pull back. So it's the thing that's come up, the fact you even said that's funny, not funny, but it's ironic, is that a lot of lenders and a lot of borrowers and, like buyers and sellers have said to me, hey, is that loan, can we get that loan can we have another bank assume that loan? I'm like, well, it's not, unless it's in the documents from which the seller actually got the loan, where it says it's assumable upon, assumable, and even on sale, it can go to the new owner. You can't do it. So what bank's going to, a 3% paper on a 30-year mortgage will say, what other bank is going to assume that mortgage when they can price that same deal now at 5 or 6, right? So what bank would assume that? Because banks are they're in the business of making money. They're not like, it's not a charity for them. So like everybody now thinks, well, it's assumable. Well, it's assumable. Well, it's assumable if it's in the loan docs originally. If not, what bank's going to let you like transfer a 3% paper when they know they can price it a fresh piece of paper with the new buyer that will say 5, 6, or 7. So it's one of those things now where I'm shocked how much I've heard that word the last, I'd say 2 to 3 weeks. Assumable.
Yeah.
Not going to happen. Not going to happen. So.
Well, I think people are adjusting to a new marketplace. And when you have Jerome Powell, who just a few weeks ago came out and said, that they're basically are going to be pushing the economy into a recession. They are going to increase rates another 75 basis points and then another 50 and then another 25. I mean, they're going to be raising the interest rates until basically what they're looking for is what exactly? Unemployment to go through the roof. People not being able to afford to buy homes and buildings. And so I get it. This is to offset inflation and it will slow down the engine of the economy. But we deal with small business owners on a daily basis. This is having a far-reaching effect beyond just mortgage rates, isn't it?
Yeah. I mean, I think you have to wait and see here before they do another raise. I don't know. I think there's a point where I'm a big believer in they watch equities. And people don't believe me on that. And they say, no, they don't. But, when Bernanke came out saying this will help, lower cap stocks go up when they did their QE, they obviously watch stocks. And you and I can argue if stocks are still expensive on a go forward basis because we can get into that. So I would say stocks are still expensive on a lot of levels, even with the downdraft we've had. But you're starting to get people now come out already and say, don't wait for the bottom. If the Fed slows down, or I think what they've done enough. I mean, it's an unprecedented almost 300 basis point increase here this year. I would think they'd almost want to sit and see what would happen and what's going to happen before raising again. But
you'd think.
You would think.
I mean, if
right?
you and I were sitting around that Fed Reserve table, we would be like, okay, guys, let's check. Because I think you alluded to this earlier, Jeff, correctly. There's a lag time. It doesn't, you don't flip on or off a light switch and see an immediate result. It's probably at least 6 months before the impact of what the Fed does with interest rates actually trickle down into the economy and people's pocketbooks, business owners' pocketbooks, right?
But you are seeing it immediately in mortgages, right? So I always tell people, when the Fed cuts, banks will cut slower, right? So banks internally, right, will cut slower. So say the Fed lowers a quarter, it might take the banks or the market in general, we'll just call it. It's going to take a while for the market in general to lower, right?
Yeah.
And not on the ones that just reset, but it's just the banks are going to be reticent to move it down. As you've seen on the way up here, if mortgages are at 7, you're like, well, what's that? I mean, that's jumped way ahead of where the market's at, right? Of where the 30-year is. And and the banks will move up faster on the increases of where they price things when there's a tightening cycle, as we're seeing. So I don't know if, I mean, you look at it, did Powell think the mortgages are going to be at 7 this quick? I don't know, but it's like you're looking at stuff that's 2 times what it was last year. And, everybody's sending out
earlier this year, Jeff.
Yeah.
You could have got a 2.5% mortgage at the beginning of this year for your home.
Yeah.
$500,000 home average. Let's just say you put down your 20%. You're now paying $700 to $1,000 more a month.
Yeah.
Than you would have been for a year. I mean, the affordability issue is coming into target right now as well.
Yeah.
People are not going to be able to afford homes that they were able to afford a year ago.
Yep. I completely agree. So I mean, we've seen what it's done to the mortgage industry and just the wreckage it's done for the employment. You and I can argue about, did they overhire, and even some of these tech companies where you have a down quarter and they lay off 10% of their staff.
Yeah.
I mean, you and I can have a talk about, is that how you run a business? I don't know. I think there's a lot of, I've heard, and this would be good, like where the Fed now is trying to get rid of some of these zombie companies in the economy. And that's a good thing. That's a good thing. I don't think that's bad, because you sit here and you watch stuff, and it's just been shocking to me the last couple of years on some deals that have gotten done, where you see deals go from bank to bank on a quote unquote workout, just because there's asset coverage. But it just doesn't even, it's gotten to the point where the market is so ridiculous and was so ridiculous, where you would have, and I'm sure you see this too, you see business owners talking down to you, telling you who they think is going to do their deal. And it's just kind of like, just shake your head, but you also have in the back of your mind, like, maybe he or she is right. Maybe this bank will do it, or throw out a big name fund on a bigger deal will do this. I just don't think so, but it's, people do have to put money to work. I don't know. It's just shocking to me, the amount of, which has been the reason that we have that attitude, or some business owners have that attitude, is because of what the Fed has done, kept rates 0 for way too long. We can all probably now agree with that. There's been so much excess and so much speculation in the market because of 0 on the Fed funds. And then you look at all the government handouts and everything, it's just gotten to the point of, I don't know, it's crazy. And if some sanity comes back in the market as a result of this, that's a good thing, because of what was going on here the last, I'd say, 2 years. You had that 6 months after the pandemic, it was hard. But then after that, David, it was like there was nothing wrong, and stuff was insane. Like, things got priced, deals you'd see, and you're just like, how is that?
I feel like
I just sit back and I just kind of am shocked.
Yeah, you and I have talked a lot over the years, and I offline here, we've had our discussions as well. But I feel like what we saw over the, since the beginning of the pandemic, all right, we're going in almost, 2.5, 3 years now. It's going to be, shortly, right? It's time's just moved by quickly on this. The amount of funding that was being pushed out into the marketplace, and by the way, it isn't just the United States. You saw this, you referred to the Bank of England earlier. You saw this in Europe. They basically just kept the economy afloat by printing money. And you're seeing massive inflation right now in Europe. They've got energy concerns because of the geopolitics that are going on right now. But in the United States, with everything that they did, it wasn't just the stimulus. It was the PPP. It was the employment credits. It was everything that they were doing to funnel money into small and medium-sized businesses, because they ostensibly shut them down. they said that you can no longer come to work, and different cities had more stringent regulations on that than others, depending upon where you are in the country. But the often said kick the can down the road metaphor is exactly what they were doing. They said, we'll take care of this down the road. Now we're down the road. And Jerome Powell, after looking at 14 years of quantitative easing, where the Federal Reserve was funneling money into financial institutions, buying out the securities, the bonds and such, they're now restricting that. Do you think that there is an argument to be made that there's a way to slow the brakes as opposed to e-braking it, which is what we're looking at right now?
I would think, like I kind of just said, I would think they would just wait and see what happens with just the economy in general. So you look at Europe, like back to what you said, Europe's slowing. The rest of the world is slowing. That will affect the US, no matter what, is going on here. That's going to affect, that might take a while to eventually trickle through to here as well, but it affects orders. It affects this, it affects which a US company, it sends it to a company in Germany, wherever, or in England.
Right. And
they start slowing down, and they slow down their orders. That affects us here in the United States. So I would think, forget just raising rates, right? So I think it's crazy to me how long we've been, like you said, in this QE environment, and we never saw inflation. And now it just came and exploded. And it's shocking. You look at, it's just been shocking that, to me, it's shocking it took this long. And to me, that's where the part I think that was just crazy. Like, you watch everything that was done in 07, 08. I mean, the Fed, like I said, the Fed should have raised a long time ago. If the Fed would have raised maybe like last year or the year before and just, started to gently bring stuff up, I mean, I don't know.
Yeah.
I don't get it. I don't get why they waited this long. The economy was strong enough to hold it. Then if you sat, say you raised 200 and you just sit and you wait and see, like if he truly goes another 3 quarters here or whatever he's thinking, I mean, we're
talking another 1.5, Jeff.
If they, like I said, if they go another 1.5, it's going to get ugly. It's going to get very ugly.
You work with small business owners. We work in some cases together. You have a really good, and this is why I love talking with you, because I think that you have a very good lens on SMBs, the small and medium-sized businesses. There's 32 million in the United States alone. The worry and the concern that we're hearing from folks right now is in regards to cash flow. It's getting harder and harder to get paid by clients. What impact is that having? When we go to the banks, when we go to the lenders, the hard money, the mezz, the bridge, whoever it may be, what alternatives are you seeing to those problems that people are bringing to you on their balance sheets right now?
Sure. So you look at, like a good example on something like that is, say, a company that works with a very big, we'll say an Amazon or a SpaceX, Tesla, one of these major major company that they're going to slow pay the customer. They're going to slow pay the people they're working with because they can. So their attitude is, you either work with us or you don't, and we don't care what you have to do. So a lot have resorted to an AR type financing, vehicle. But I always tell people, projecting cash flow is great if you can deliver on it. It doesn't mean, projections just don't mean a lot to me. And I'll try to be politically correct in what I say and not offend maybe some people on it. But it's like, there's only so much, like, you have to deliver on that cash flow model for the model to work. The model doesn't work if one part falls off. And I think that's what people need to, plan for. And that's what they are starting to plan for, where cash flow is now you're seeing it's going to now trickle down through everybody, where everyone's going to start getting, you would think, slow paid based on cash flow, right? So that blows your model up immediately. and people just think, well, I'll just go get it when I need it. And to go get a finance vehicle when you need it, as we know, is not a good option, because generally, if you're going to get it when you need it, the rates aren't good, you don't like the options, and you don't like the timing on how long it takes to get it. And I think that's what people need to keep in the back of their mind. They need to have, I would say, facilities for cash flow in place. Even if their cash flow looks good, the first sign of stress with, say 1 or 2 of their customers, I would make sure you have some type of vehicle in place to survive a slowdown. And you don't want to call someone and say, I need the money tomorrow.
Yeah.
That's never a good, you're just not,
you're
just not going to have good options.
We laugh about that because you and I have both dealt with, folks, licensees of ours that bring us cases or directly to you. And, we're laughing about it because it's like, yeah, okay, we know that you needed it yesterday, but here's the reality. And it is oftentimes a reality check for the client. But this is one of the reasons, again, I like to speak with you, is because you seem to be able to thread the needle on some of these situations whereby they're either turned down 100% by lending institutions, or there's alternatives. There's different vehicles that are available to them that may have not been considered. And you may be able to back into a deal. Some of those cases we like to deal with because it gives us cash flow and liquidity to restructure and do a discount payoff with the lender. Maybe it's the bank or whoever it may be. And so in those particular types of cases, we're seeing a huge upsurge right now because of cash flow issues. Cash flow is the number one problem businesses, small, medium-sized businesses are facing. The stimulus money, the PPP, all of that stuff is now filtered through the system. And so there's going to be some cases that we're not able to help, aren't there?
There's a lot, David, and that's what's scary. It's very. I'll go back to the deals where you see that are getting kicked out of the bank. Most of them, not all of them, but I would say most. We'll say 75 to 80% of the ones we see that are getting moved out of banks. There's really no real viable option that would make sense financially for that business, and that's just kind of where they're at. It's just, like I said, to me, it's always, you need a plan ahead, and that model, those projections, you have to assume once you see one little sign of stress from, say, even one of your main customers, you got to start to be proactive and start making sure you're going to have cash flow when you need it. And there's ways to work around it. There's different things to do. But like I said, if you wait till that last minute, there's not much. I mean, you're just not going to like the options. And there's things you can do, but and there's we know how it is, and in some of those places where you should only take those types of debts if it's just strictly a bridge, not like what's my permanent financing. And we're seeing more and more of that where people are being steered to, I would say, some of these higher rate loans when they didn't need to, maybe because it was easier. And like I said, there's a time and a place for every type of funding that's in the market, but you need to make sure you use it at the right time and have a plan to get out, to have something permanent in place that makes sense.
In other words, put yourself into some form of financing that will get you through the next 30 to 90 days, and then find a way to refinance out of that. You have to
have a plan behind it, right? To just keep taking Band-Aid after Band-Aid after Band-Aid doesn't help.
Yeah, and there's a term out there now called stacking, and you see this with some of the merchant, cash advance type situations, which are horrific. The impact on.
We're starting to see more and more on those where it's, Jeff, help us consolidate these, get us in a better place.
Yeah.
So we're starting to see a lot of that, which is good. At least they notice there's a problem. And the easiest ones are the ones that you work with that know they messed up by taking this many of them.
Yeah.
That's where you can work to try to figure something out. The ones that just kind of want to, I don't know if it's a lack of, somebody just gave them bad advice, or they just didn't want to sit down and do the paperwork to actually get a true I would say, line of credit in place.
Some
It's
people feel they just have no option, Jeff. There's
Well, they
no
feel they
other
have no
option.
option. There's a lot of,
Yeah.
I would say there's a lot of questionable advice going around right now.
Yeah.
Trying, you know what I mean?
Tremendous.
And
Absolutely.
it's very interesting. You know, I'll get it from, there's a lot that I've turned down where, you know, I'll get an investment bank to call us up. Hey, will you help us out on this deal? You know, just help us get a bridge. And you have stuff that's, like you said, you have some MCAs that have been stacked that really shouldn't have been stacked. Like there's certain reason, you know, sometimes there's a reason to do it, right? I get it. I understand that. But if there's a reason you just went and did it and then like call us up to kind of like rescue it, when it's like, what were you doing the last 6 months? And that's what really, that's where we've turned down a lot of deals, I would say recently, especially where it's like, guys, I don't know what we've done here and it doesn't make sense. There was other options available, but now you have groups that are going to back away from touching this.
You got to qualify your clients. I mean,
Yeah.
we do this. This is one of the cornerstones. You know, you're not going to take on a case that you're going to do a ton of work on for the next 2, 4, 6, 8 weeks, whatever it may be, and ultimately not end up getting paid. You got to take on a deal that you believe has a good shot. And so unfortunately, that means turning away some business or potential business. That's always hard to do.
Yeah, we're turning away a lot, I think, right now.
Yeah.
And you know, we'll look at every deal. I mean, but I just think we're much more. I think I know what's coming. I know what's coming. I think we have an idea that it's going to get more busy for what we do. I think.
Let's finish up with that because you know we're heading into the fourth quarter, and you know there's arguably, depending upon who you speak to, we're either going into a deep recession or we're going into a light recession. Things aren't good either way, right? So what do you see is coming down the road here over the next 6-12 months?
So you look at, so I'll go back to, so you look at just a small business. We'll say they got an SBA 7A. Okay. And they got one that's, we'll say it's one of the places that sells them and it's prime plus 2 3/4. Well, prime's at what, 6 1/4?
Yep.
Where's their rate now? Their rate today, Dave, is 9. Their rate today is 9%. When they started the year at what, 6? I think they were at 6, right? Because I think it was 3 1/4. Now we're 6 1/4, right? So we're at 9. So we went from
prime was 3. Prime was 3 1/4.
3 1/4. Now it's 6. You're 6 to 9%.
Right.
I'm saying it's a $4 million, like, and that resets quarterly.
Yeah.
I mean, that's, and anybody was telling me that's not a big deal. That's an enormous difference. And I turned down a deal yesterday on a deal we saw where I don't know what they did. They didn't set it up right from the start. And they should have got it done in February, to be honest with you. And he should have gotten a 504. But now he's kind of stuck.
So it's real estate based?
Real estate based. Okay. And it had equipment too. So you can you can stick the equipment behind it.
Right.
And do a 504. Should have done a 504 to start. Now with rates have gone up, there's no way to put him in something. I think his rate at his bank was 6. We'll say 6. So you could have put him in something better at the beginning of the year. Now his options, everything's going to be worse than where he's at. So you're like, and his numbers aren't, they're just not great right now. So he had a better shot at the beginning of the year than doing it now. So now he's stuck. I'm like, you're probably going to have to be an SBA 7A at prime plus 2 3/4. So I run the numbers and I'm like, it's not even, you can't even present it to the guy. Like, it doesn't make sense. Yeah. Like his monthly payments are going to go up by like 5.
You're talking about the issue is servicing the debt now. They're unable to service the debt.
His monthly payment is going to go from 5 to 10, like 5 to 10,000 higher. So it's like, you can't even like, he thinks he's going to cut money. He got on the phone with me and I think he honestly thought he was going to save money on his mortgage. And I'm like, send me your stuff. So he sent it to me. I just ran the numbers really quick. It's not, I mean, you just plug, I can plug the numbers in the spreadsheets I have and try to figure out, how does this make sense? Where do I think I can line this up?
Right.
And I'm like, I just got to put you at prime in 2 3/4 because you haven't delivered on what you thought. And it's a little bit less than what it was in 21. He's in the food industry, so he's got caught up in the inflation piece. What do you want me to tell you? His numbers aren't great. And he had a better shot at the beginning of the year than he does now. Plus his rate he could have locked in a much lower rate. He could have at least locked a lower rate than he's at now. Now he's only looking at options. He's looking at basically SBA 7. His options are good. He's prime plus 2 3/4. It's got to go to a place that's going to sell it. Prime plus 2 3/4. He's at 9. He's at 9. Now, if you're telling me the Fed's going to raise another 1.5, he's suddenly at 10.5 from 6. Well, what I mean, I don't know what to, like, so this is happening everywhere. Like his bank rate was 6. So I don't know what to, that's very typical of what we're seeing in the market right now. It's stuff like that where guys, business owners are thinking they're going to refinance lower. And I'm kind of,
listen, people have been conditioned for the past 15 years to think this way.
David, it's crazy, but we'll get people that call us up. I'm sure you do too. Like, I want to do that at 3 or 4%. I'm like, what world are you living in? Like, what?
Right.
What do you? I just say that. I just gently will say the market is nowhere near there.
Yeah.
For your business, for how your business is doing financially, and the industry you're in. So we'll say it's whatever industry. Just you look at the deal and you're like, you're not even close.
I'll just finish with this. You
can't even say to it. What are you going to say to them? Your real rate is 7. Why even bother? That they're not going to work with you. So you just say, I think you need to figure out what's truly in the market.
Business owners are very good at what they know. They have their product and their service. They started a company and they're dealing with that. You and I are kind of on the front lines in regards to representing business owners, in your case to the lending community, our case obviously working with their creditors to try to restructure these debts and bring in some alternatives, but it's amazing to me, Jeff, how many times we speak to people. Even today I had a conversation with somebody and they had no idea how high rates have gotten.
No idea.
They know, a lot of people don't follow it closely. People are tired. They work 16, 18 hours a day in some cases. They come home, they grab some food, they spend some time with their family. And so, the issue is you've got to know what's going on in the economy when you're representing your client. It's critical.
But David, I'll go back to this. We've seen some other deals where they're private lender deals. And this is still within this last, we'll say 7 days, David.
Okay.
Deals that, we'll say one's in the oil and gas industry. That's what it is.
Yep.
And it's an equipment deal. But the gentleman who is the CFO was telling me it's like a roll up and he thinks a bank's going to do it. And he's been working with the banks for like 3-4 months. And I'm like, it's just not there. It's not, but he's got bankers telling him term sheets coming next week, term sheets coming tomorrow. It's stuff it's stuff I don't, it's stuff you just don't do. I don't say stuff like that to hold a client, I would say, hostage. And I'm shocked the number of banks that are now, I'm hearing that more and more, where the business owner tells me how the bank's going to do it. They're going to give me a term sheet tomorrow. And I don't know if it's just, it's very interesting. So there's a lot of bad, I would say, info out there from every angle at this point. And it's shocking to us. Because like I said, these are deals that there's just no, the bank's seen it for 3 months. The bank's not going to do it. And
right.
What's going to change? Like what's changed in the market? Say this oil and gas one. Well, oil and gas have come down. So what? So that makes it you want to do it now? I don't. You know what I mean? So you kind of look at. It's just It's going to be an interesting time. I think the banks are going to have some interesting times. I think you're going to see some. I would think some major layoffs coming through the banks. I'm sure you probably saw where just the investment banking arms of like Goldman and JP Morgan have, their volume is way down, enormously down to half from what it was last year. I mean, they're just not. I mean, there's not a lot.
We're seeing it in banking. We're seeing it also in logistics. We just saw the owner of Federal Express last week talk about the fact that there is a massive, massive correction coming, and they're laying off. They're trying to figure out how to save 1.2 billion through layoffs.
Yes.
Huge.
So I mean, and they're touching back to what you said, where it's, people that touch the small business, they touch the small, medium-sized business community as much as anyone, right?
Right. That's the harbinger right there.
That's it right there, right? That's it. And I know there's been a lot of upheaval within some of the people that do like the last line delivery for FedEx, that do those, those lines and stuff. So
the independent contractors.
The independent contractors do that last line delivery,
Yeah.
For FedEx that are, it's a quote FedEx line. They've traded a lot the last couple of years, and it's very interesting. But there's only so much. I mean, I don't know what you want FedEx to do if the economy's slowing. Back to what you said, like there's only, like, what can they? There's just that only so many packages. What do you want them to do?
Right. Well, you had expendable income over 2 years. You got stimulus money and PPP money, and people felt comfortable, buying supplies and products for their companies, or individuals buying, products for themselves, Amazon, whatever it may be. And, the street that I live on, there's Amazon trucks every 10, 15 minutes, UPS trucks.
But Dave, so then David, I ask you then, I turn that back around. So I see that on my street. Is the economy really slowing? I mean, I go back to this, right? I trust me, I think it is, and I think it's a lag, and I think it eventually will happen. But I mean, have you seen less Amazon trucks on your street? Less FedEx
I don't know how much of an impact somebody spending $20 on Amazon has, as opposed to a company investing $1 million piece of equipment and deciding to pull back.
Well, I agree. That's a completely different thing. It'll be interesting to see. Like I said, it feels like a lot of the economy is still kind of hanging in there. But like we said, there's going to be a lag to what's going on. And
it is a lag. It is a lag. And numbers are definitely going less. Gas rates, they came back down a little bit, still from their high. They're still well over where they were a year ago, but now they're going back up again. So, and then again, you got the geopolitical issue I don't want to get into in Europe and Russia and such, but all of that. And we didn't even mention China, Jeff. I mean, the real estate, both commercial and residential real estate market in China is literally imploding. It's a disaster. There are bank runs with people that invested in real estate over the past 2 years to be developed, and now they can no longer take their money out, but these homes are not being built. It's a disaster. So you're going to have contagion from Europe. You're going to have contagion from China. We've got the raising interest rates in the United States. All of this, like you said, lag time, 6 months, a year. I don't know what that looks like, but you know what? Hold on to your hat, folks.
I mean, that's the one way you can say. I don't. It's crazy. Like I said, I'd be shocked. They said they're going to do it again, but I don't know. Like, you got to sit back and see.
Greatly appreciate you taking the time, my friend. Tell everybody where they could find you and your firm, what you guys can do to help folks out.
We're www.superiorbusinesslending.com, all one word. That's it. I'm on LinkedIn, Jeff Gerstner. That's it. I mean, we're relatively easy to find.
A very active profile, by the way. I just don't do social media enough.
I try to be out there quite a bit, and it's hard for people. A lot of people comment like they love my writing, and
it's good.
It's so hard. It's hard for me to write it because I'm not a gifted writer like some of the people I follow on LinkedIn. So it's hard for me, but it's one of those
you do a great job, and you keep everybody informed, and I enjoy our discussions, and that's why I wanted to share this type of discussion with our folks, and greatly appreciate you taking the time, and we'll be talking again.
Thanks, David. Talk soon.
Thanks, Jeff. Greatly appreciate it. Bye-bye.